Good evening, everyone, and welcome to tonight's live stream. Hope you're enjoying your day or your evening, depending on where you are in Canada right now. Tonight, we're going to be talking about an interesting subject, namely because they announced the inflation rate for May. And so there's your title for today. I thought it'd be timely that we talk about inflation because it's going to be on everybody's mind, and it's going to be across every news channel today. So I thought it might be useful for us to actually talk about that tonight. Please let me know if you can hear me in the captions below. If you are hearing me, go ahead and give me a thumbs up, and I'd appreciate that. And you can type in your comments or questions in any of the areas that you're watching tonight. So welcome, everyone. My name is David. I'm an advisor working with clients right across Canada, and I make educational videos on just about every financial planning topic you can think of, whether it's retirement planning or estate planning, just financial planning, trying to protect your assets and grow your assets, how to mitigate taxation in your estate, or even just as you go forward, investing. If you're a business owner, how to pull money out of your corporations on a tax-free basis, or how to protect your money from people that you don't want to have them have access to your money. Lots of different subjects. And I could talk and make a lot of videos around a number of different subjects, but I am an active advisor. So I'm busy during the day working with clients, doing financial plans. And yes, I actually do financial plans for my clients. I update those plans every year, and I update them throughout the year when clients give me any material changes to their financial situation. So I do make financial plans, and I invest my clients' money and then protect all of those things using life insurance products. Okay, so let's dig into this right now. I hope you can hear me right now, and I hope you're enjoying. I'm going to try to get through this as quickly as possible because I am aware that tonight is the fourth game of the Stanley Cup Finals between Tampa and Colorado. So I know that a lot of people are interested in not missing that. So let's dig into this. We're going to, if you have any questions, this is streaming across LinkedIn, Facebook, and YouTube. So you can just go ahead and fire your questions, and I'll get into those as well. And if you have a question after it's over, put your comments in there, and I'll get to you to your question as we're later on in this session. Okay, so what are we going to talk about tonight? We're going to talk about Canada's inflation rate and everything about inflation, what's causing inflation, and what are particular areas of our economy that are under pressure right now. And then the second thing we're going to move into is actually how to position your portfolio to do well during times of inflation and having severe pressure in the market. So those are two areas that we're going to focus on right now. So let's dig into this and get into that. I mentioned already that I do videos, so check out my YouTube channel for a lot of different subject matter on videos. So today, Canada's inflation rate jumped to 7.7%. That was the May number, and it's the highest we've had in terms of inflation since January 1983, a long time ago. So you can imagine the kind of environment that a lot of people are thinking back, that, you know, this is a time when, gee whiz, I was just graduating. I think I was still in high school at that time. So you can think about that is a long time to have inflation so low over these periods of time. And all of a sudden we have this huge number. It's deeply alarming to a lot of people. So we're going to get into that right now on how to navigate that. So there's your Canada's inflation rate, 7.7%, the May number, April 6.8. I suspect that before too long, I suspect that we're going to see the June number probably 8% or higher. So going to be part of the theme tonight is that you're going to see that inflation is not going away anytime soon. If we dig into the underlying issues with the inflation, this is the inflation rate forecast. You can see the government of Canada is very optimistic prior to 2024 of having inflation down around 4 or 3%. I think that's really optimistic, but we'll see. I know in the US, and I'll show you the US numbers shortly, that the United States is also forecasting inflation to be high for the next 2 years. If we look at the bank lending rate for right now, current lending rate is 3.7%. That is the prime lending rate. And you can expect to see that prime lending rate continue to go up throughout the year. And you're going to see in some of the videos, in some of the slides today, I'm going to talk about housing, but in the previous live stream last Wednesday, that's June 15th, if anyone wants to check out the YouTube video, I talked a lot about real estate. That was a big session on real estate, what's going on with real estate values in the GTA. Outside of the GTA, broke it down in terms of what, I'll put the link in the description. I can't put it in the video, but I talked about types of homes and the values, the declines, the demand for whether it's townhomes, condos, detached housing. I put all of that in a video last Wednesday. So check that out because it'll be useful if you're wanting to check out how inflation is affecting and interest rates is affecting the housing market. If you look at fuel prices, this is reported in US currency. So it's $1.56. So it's just over $2 Canadian. Fuel prices are driving, so energy prices are driving the cost of the rise of inflation. And in the videos that I've had previously, fuel prices are here to stay. And until whether there is a geopolitical event resolved in Europe or until there is a fundamental policy change in the way that government in Canada and the government in the United States addresses fuel, then we're going to have high fuel prices. And typically we end up having high fuel prices through summer months. That they say that they don't raise fuel prices during the summer months, but this is going to be, and especially the fact that we have been emerging out of COVID restrictions, people are going to want to get in their cars and go somewhere. So you're going to see that I don't suspect fuel prices are going to drop anytime soon. Okay, so the next slide, in terms of the inflation, household debt to income, look at this number. So if you see July, let's go back February 2021, was really quite low. And that was largely due to people being concerned about COVID, right? We're about a year in to COVID at that point, heavy restrictions, working from home, many of us, and not being able to spend our money. We weren't really taking on a lot of debt. The only debt that people were really taking on at that time were in terms of real estate. People were moving out of condos or moving out of the city where they didn't have an option to be able to build, didn't have like a home office environment, and the kids were staying at home and everybody was cramped. So you saw this huge migration out of the GTA or out of Toronto into areas where they had backyards, where they had an extra room to be able to build an office or suite. Just more space for everybody so that they, during COVID, you don't want to be standing on everybody's head. And I think you understand how that worked. And so there was a migration out to those areas and the home prices went up dramatically. And people really weren't taking on debt other than to do a renovation to make their home available to be able to work from home. But beyond that, I think people were quite worried about what was going to happen a year from now or 2 years from now. And we saw that started to change as people were living and working in their homes. They started to realize, okay, this is the way it's going to work. We're all getting used to this environment, and people started to take on debt. You can see here the debt rising through the last half of 2021 and rising all the way up to 2022. That's the February number. And I suspect that that's not going to change. I think that people are going to continue to take on more debt. But now that we have interest rates rising, that's going to be a little unaffordable for a lot of people. So we might see the mortgage, and I think we have already, if you see the recent news with mortgages, I'm not going to be talking about specifically about mortgages tonight, but mortgages in the United States, brokerage firms laying off hundreds of employees who are doing mortgages because they know that volume is going to shift to being low volume. And we see now that the home prices really aren't really being affected by the inflation number yet. They're being affected in the sense of the number of transactions that are going through. And so we're seeing that's where you're going to start seeing the volume of mortgages will come down. But let's just try to stick to this. Building permits. This is a really good one. I think, building permits. This is just evidence of the slowdown has already occurred in the Canadian market in terms of building permits. This is going out and building new homes, renovations. We're seeing a dramatic change from February all the way down now March and April. So we're going to continue to see building permits being less and less. The building permit forecast. Now, this is something that's really interesting. You see that line, that gray area line going across the screen. That is, I think, anybody's best guess, because there's the demand for homes in Toronto is not going to weaken because of inflation. People are immigrating to Canada. 450,000 people are going to be immigrating to Canada this year and the next year. And there's a demand for housing in Canada, and specifically in Ontario, where the two provinces where people want to live mostly, we'll say, Ontario and British Columbia. This is where you've got the most expensive cost of housing. And that's not going to change. People are going to continue to want to live in Ontario, and we're going to need to continue to build homes. It's going to price. I think what we're going to see is we're going to see homes that are on the high end, say $1.5 million, $2 million and above, are going to be continuing to build, because the trend is those prices are continuing to rise. And that area of the economy and those people can afford to buy those, no matter what the mortgage is going to be at. And then the price point of, let's say, $1.5 million and lower, this is where you're going to see more of that housing being built, because that's obviously the demand. People need to get into homes that are affordable. Okay, so next one is, how are we doing so far? If you have any questions, put your comments below, whether you're on Facebook, LinkedIn, or YouTube. Just type in your comment or a question, even if it's just a wave and say, hey, how you doing? It's good to see you there, but I can answer your questions on the fly. What I'm also going to be doing this evening is, as I'm going through this, like in every other live stream, and this format is different from my other videos. This format is live. So as you have questions, I take your questions. If you want to talk about something that's unrelated to tonight's topic, no problem. Send that through. Let's talk about it. So it's completely different format from my other sessions where I have the recorded videos on YouTube, and it's about that one topic. Okay, so this is the next slide is really some more inflation numbers. Food inflation. Food costs are not going to be going away. Expect to be having high level of food costs throughout the rest of this year. That is not going to diminish. So whatever your thinking is over the holidays, or like in the summer holidays and vacations and so on, you're not going to get a break at the grocery store. And there's the forecast for food inflation. So again, they're forecasting that's a fairly dramatic drop in food inflation over a period of a few months. I don't really see that happening. I think that's someone's optimism. As long as we have a supply constraint issue, as long as we have high cost of fuel, we're going to have high food costs. It's just that simple. Consumer Price Index, CPI. This is important to know because every year government benefits are increased by the CPI, but you can see here that the actual CPI forecast is not going down. So isn't this interesting that the food cost is saying that the forecast is that it's going to go down dramatically, but we don't see CPI coming down. It actually kind of flattens out, and then in 2023, they're actually saying we see this going up more so. So it's an interesting forecast for us to see what they think inflation is going to be really costing us. Okay, this is the U.S. inflation target. Now, this is basically saying that the United States Federal Reserve expects to have their lending rate at about 3.5% by the end of the year. So when you think about the United States and Canada, they tend to be in lockstep. Today, they were talking about that Canada is likely going to raise interest rates by 0.75%, and that there's a growing consensus or call, if you will, for them to raise interest rates dramatically by 1% to really shock the market to get everybody to see that we need to get inflation under control. And by doing 1% shows that there is an absolute sense of urgency about getting inflation under control. So the consensus is 0.75 to 1% in the next meeting, which is coming up shortly. But in the United States, they're already painting a picture. We are going to raise interest rates another 2% at least by the end of the year. So can you honestly think that Canada is not going to be in a range that is close to what the United States? I can't imagine they're going to be too far away from the United States before the end of the year. Okay, so now let's look at how to lower inflation. Just check to see the chat and make sure if we have any questions. We're going to now get into how to lower inflation, and this should be, or how they lower inflation, and then what we can do about positioning our portfolio so that you can take advantage of higher interest rates and higher inflation. So let's get this caption out of the way. Okay, so the first step is the Bank of Canada raises interest rates. That's what they're doing right now. Banks charge households and business higher rates on loans. That's the next step. And we see that the mortgage rates are going up. Households and businesses cut back on spending and increase savings. This is where the economy starts to slow down. People start thinking about it's going to cost us more. Maybe we need to tighten up our expenses. Maybe we shouldn't spend on anything that is really going to increase significantly our expenses every month. So these car purchases might be put off a year. If you don't need to buy a home right away, chances are people are not going to go and buy a home right away. They might say, you know what, I wonder if home prices might be a little bit more affordable a year from now. So people are going through this thinking, even taking vacations. You think about taking vacations. So many places around the world are starving for tourism, and they have so many great deals on, and people will go away. But then there are other people who say, I don't know if it's the right time for us to spend $5,000 or $10,000 on a family vacation. Maybe we should hold off for another year. So those are the decisions that a lot of the consumers are going to be making over this next 6 months. And that's going to slow down the demand for goods and services. This is just typically how that process works. Companies raise prices more slowly or lower prices. So this is where companies start to, I don't want to say play around with prices, but they start to figure out where the market is in terms of what people are willing to pay for their goods and services. And it's really a position where people are in the driver's seat, where they're not spending money. They don't want to spend money. And so this is where you'll see a lot of retailers trying to induce people to come in and shop. You'll see sales that'll go on to just try to get people to come out and shop. And this is how inflation drops. So that is sort of like the process of how things are supposed to work going forward. And the question is, will that actually happen given the fact that we have two variables that are so messing around with that being the high cost of fuel? Three things really: the high cost of fuel, the supply demand constraints, and the geopolitical event in Europe. I'm being careful about how I say that because YouTube likes to ban accounts that talk about certain geopolitical events. Okay, so how can you best position your portfolio to take advantage of rising inflation or rising interest rates? What can you do? So let's talk about specifically what you can do. Here is a chart. This is annualized returns during rate increases and different types of investments. So bank loans, average is 5.5, short-term bonds is 2%, long-term bonds 4.1%, high yield bonds average is 7.9. You can see the difference between, this is the two columns, 2004 to 2006 and 2015 to 2019. Okay, so these are periods where we had rising interest rates. So back to high yield bonds and municipal bonds, 3.8%. Large cap stocks, the average is 9.5. Large cap value stocks, the average is 10.8. Large cap growth stocks, 8.1%. Developed country stocks, this is ex-US, 13.5%. REITs, real estate investment trusts, 16.4%, gold, 15.9%, and global commodities, 7.3%. So that is kind of like a good cross section of all of the different places where you could be investing your money. And so the question is, well, what does that mean for me in terms of how I invest money? Because maybe you're not investing in stocks, but that's okay, because if you're investing in funds, the funds invest in the underlying security in a fund, whether it's a mutual fund or a segregated fund. The underlying security is a stock or a bond or REITs or real estate in general. There are funds that just actually invest in buildings, commercial buildings. So you have to think about, if you look at that chart again, later on, you can rewind it on YouTube and look at that chart and think about, in those two periods where interest rates were rising, these are the kinds of sectors that actually did well during that period. And so if you think about the funds that you're in, what kind of investments are inside of those funds relative to what I just talked to you about? And then, of course, you have to look at your risk tolerance and your time horizons, because that's a sort of like telling you, here's what this did during those periods. But you may not be you may be risk adverse and say, I don't want to have so much of equity component to my portfolio. So you have to look at your risk tolerance, how much fixed income, how much equities you can put in your portfolio. Go onto my YouTube channel. There are videos that just talk about analyzing your own risk and analyzing different portfolios, whether it's 60-40 split or 50-50 split. There's some great videos on that subject, okay? So what are the things that you need to consider during these times? So let's just look at fixed income, okay? Long-term bonds, I'll get my picture out of there. There we go. Long-term bonds outperform short-term bonds during the last two rate hikes, but at higher levels of risk. You have to consider that. So the portfolio implications would be taking risk into consideration. Investors may want to diversify your portfolio with a variety of bond durations and maturity lengths. So if you are invested in any fixed income fund, there's going to be funds where you can actually look at what kind of bonds do they have in their portfolio, short, medium, and long-term bonds. So you can actually see if this is actually a short-term bond portfolio or a long-term bond portfolio, or is it a basket of all of those short-term, medium, and long-term bonds. Stocks. Growth stocks have outperformed value stocks over the last decade, but this trend doesn't always hold true during periods of rising interest rates. So for your portfolio, investing in US large cap or Canadian large cap, which includes both growth and value stocks, has historically had the least risk. I'm going to be doing a video on this shortly, talking about the differences in terms of not just market timing, but also about types of investments and how they've performed in different interest rate environments. So stay tuned to the next video that I'll be uploading soon. Alternatives. Global commodities had the highest average return, but also had the highest risk. So for your portfolio, investors may consider holding a portion of their portfolio in commodities if they have a high risk tolerance. So what does this all mean to you, especially in commodities? We see that, and I said it in the other video, that we see that energy is high right now, and energy will remain high for the short period of time, at least until Ukraine, Russia is resolved. When that happens, we should see a drop in oil prices. And the idea here is that it's extremely volatile. It's been working in your favor while you've been investing now, taking advantage of, and I don't want to make it sound like you're not you don't have any compassion to what's going on in world events, but it's what happens during these times. And we're moving into a weather cycle where we have weather events that, hurricanes that disrupt oil delivery into the United States, North America, and so on. So this is a time of the season where oil prices can go up because of the disruption from weather patterns. So those are the things that for now, over the summer months and likely into the fall, you should continue to see high oil prices, high energy prices. And so it would be a good place to be invested. Just understand that if something does change, bang, you'll see oil will reverse its position, not like going down to $70 a barrel, but it'll drop fairly quickly and dramatically off of its peak right now. Okay, let's move on to the next slide, and we are almost done. If you have any questions, did I go too far? I think yes, I went too far. Okay, if you have any questions, because I think I'm done for the night. Can you believe that? 25 minutes. I want to make sure you can get to your hockey game tonight, because I know it's so important for everybody. If you have any questions, go ahead and put them in the comments. If I don't get to them, I'll reply to your comments after the video is edited and put onto YouTube. And I'm looking forward actually to seeing the next video. I appreciate you taking the time tonight to be on my live stream. I look forward to seeing you next Wednesday on the live stream. If you have any questions around financial planning, retirement planning, estate planning, go ahead and look me up. There's about I always say there's about 5 million ways to reach me. And I'm able to help you with whether it's doing a financial plan for you or just talking about how to protect and grow your wealth. I always end my sessions by saying we take care of your wealth management so you can take care of what's most important to you. There's my contact information. I appreciate you taking the time tonight to be on the call and on this video with me tonight. I look forward to seeing you next Wednesday. Have a great evening, and I hope your hockey team wins tonight. At least I'm hoping that we're going to see Tampa win. I'd like to see them win another one. It's always nice to see dynasties being built, right? Okay, thanks for joining me tonight, and we'll see you next Wednesday. Take care.